Hello, and thanks for joining us. I'm Callie Breeze, and it's my pleasure to welcome you on behalf of Thrivent and our financial advisors to this market and economic update. We hope you come away from this conversation with a clearer understanding of what's going on in the economy and the markets. We'll get the latest thinking from our investment leaders on economic trends, including inflation, employment, and the geopolitical environment. We'll also talk about small companies and their role in the economy. As always, we are going to cover a lot of ground. Keep in mind that your financial advisor is the best resource for you as you think about how this relates to your personal financial strategy. So let's turn to our panel. I am joined today by David Royal, Chief Financial and Investment Officer, Steve Lowe, Chief Investment Strategist, and Jim Tanucci, our Senior Portfolio Managing Small Cap Stock Companies for our investment team. Thanks, guys, for being here.
My pleasure.
It's great to be here.
David, I'm going to turn the mic to you to introduce Steve and Jim.
Sure, and Steve will be familiar to our past viewers. Steve leads our mixed asset group that oversees our asset allocation funds and other mixed asset products. Steve was formerly our head of fixed income and started his career on the equity side. So Steve's kind of done it all, as you'll hear today.
Great to have you again, Steve.
And then we're thrilled to have Jim with us. Jim Tanucci runs our small cap stock fund. I'm going to embarrass Jim. Jim just won an award. His fund was named #1 in its category by Lipper, which rates mutual funds over the 10-year period ended last November 30th. He was #1 out of 612 funds in his category on a risk-adjusted basis. So congrats, Jim.
You say my name, but you got to give the credit to the whole team.
Whole team.
Wonderful. Well, let's dive right in. I'm going to come to you, David, with question number 1. We are a couple of months into 2024, and things are certainly looking far more rosier than they did at the beginning of 2023. But you were the earliest to suggest that maybe a recession wasn't inevitable, and also that the economy might be in the midst of kind of a slow takeoff instead of searching for that soft landing. Would love to know what drove your thinking there.
Sure, and we forget now, it's been a good year or so, but things were pretty bad in the second half of 2022. Inflation was over 8%, around close to 9%. In August of 2022, Chair Powell had given his pain speech about the economy, meaning unemployment was going to have to go up. We were going to have to experience some pain. And the consensus was, the Wall Street consensus certainly, was that we were going to have a recession in 2023. But something was going to be different this time. And the reason why most commentators thought we were going to have a recession was the yield curve was inverted, which means short-term interest rates were higher than long-term rates. Long-term rates were lower because in anticipation of recession, and the Fed had tightened short-term rates. And economic momentum was slowing. We talked a little bit last time that some of the demand had been pulled forward due to stimulus, right, coming out of COVID, and we were starting to see the economy slow. So a lot of folks felt that those two factors would result in a recession. But on the other hand, and this is what I thought might be different, is we had a lot of momentum coming out of the recession. We've only had 4 recessions in the last 40 years. So I felt that that underlying momentum in the economy, as well as just the history of it all, was probably more important than the technical aspects of the fact that the Fed was having to raise rates aggressively to soak up some of the COVID liquidity. And that was in line with what we were seeing in our broader portfolio. We've talked about some of our private asset classes before, our private equity portfolio, our commercial mortgage portfolio. And we were seeing some underlying strength in Thrivent's private asset classes as well. And that led me to believe that I felt like this was going to be more like a situation where we have continued economic strength for more than just a couple years into a recovery.
Yeah, it's interesting because consensus swung from expecting a recession to no recession this year, so the market kind of moved more toward our view.
I can't wait to hear more about what you're seeing and thinking now. We do have a poll question, number 1 here for you, our audience. We want to know, how do you feel about current conditions compared to future conditions? You have 5 options. 1, you feel better about future conditions than you do current conditions. 2, you feel better about current conditions than you do future conditions. 3, you feel equally optimistic about both. Or 4, you feel equally pessimistic about both. And we'll actually give you an out with I'm not sure on number 5. While you answer, I'm going to go to the panel to get some of their thoughts on kind of these broader themes. Would love to know, Steve, I'm going to start with you. What are some of the main themes you see playing out kind of this year at the macroeconomic level? Would also love to know if you're seeing any cross currents at play.
Yeah, there are cross currents. I mean, the key to the U.S. economy, as always, is the consumer, and I think the theme here is resilience. So the job market remains strong, and if people have jobs, they have income, and if they have income, they spend, and that drives the economy. I mean, it slowed from kind of this torrid pace during stimulus and during the pandemic, but it's still really solid. You know, the key question is how long can they maintain strong spending? And here, that's where you're getting some cross currents. So if you look at retail sales, those have slowed recently. But you can also access real-time data from the credit card companies, and that's a little more mixed. Some are slowing, and some are actually really strong right now. You know, it's clear that consumers have had to dip into their savings, or some of them at least. But offsetting that is that you have really strong household wealth. So markets are up, and home prices are up, and that creates home equity. You know, on the other side, you know, you do have delinquencies rising. So on debt, especially for lower and middle income, and that's, you know, credit cards, autos, mortgages, and, you know, higher rates are a burden, and that's showing up. But if you look at the consumer as a whole across the country, debt relative to income is actually low versus history right now. So while there are cross currents, and clearly some people are stretched financially and hurting, you know, overall the consumer is holding up.
What do you think, David?
Yeah, you know, Steve mentioned accumulated savings and consumers drawing down savings. By most measures, consumers had exhausted their excess COVID savings sometime kind of September, October, the last part of last year. So definitely seeing some signs of strength. You know, my concern is that the Fed might hold rates too high for too long. And why is that a concern? Well, as Steve pointed out, the consumer's in very good shape from the long-term perspective. Home prices have gone up a lot. People who own homes have a lot of home equity. Borrowing against homes is quite low historically. And with all the market appreciation, people's balance sheets look pretty strong. But in the short term, consumers are feeling a little more stress. You know, they have to borrow more to, you know, make auto payments, and so if the consumer wants to maintain its strong spending, they're probably going to have to borrow more from some of this pool of long-term assets to fund some of this short-term spending. And they have the ability to do that. But the reason why I think the rising rates are important is that will cost them more to do as rates go up. And, you know, the Fed often talks about rate changes having long and variable lags. That's a Milton Friedman quote, the famous economist. But they have long and variable lags when the Fed is raising. And so people still have their mortgages and things resetting. Our church actually had a variable rate mortgage that reset recently. So we're paying a little more than we used to. But also, once the Fed starts cutting, it's going to take a little while for those cuts to flow through the system and for us to see that increased liquidity.
Yeah, the common estimate is anywhere from 1 to 3 years before it's fully felt.
Okay. Jim, you want to round us out with some thoughts?
Yeah, of course. I mean, the consumer seems strong, but where they're spending is, you know, shifts around from time to time. You know, for example, during COVID, we saw a lot of increase in demand for outdoor activities, right? The spending on boats, spas, side-by-sides, RVs, that all accelerated. I don't know if you drove by any of the dealer lots.
They were pretty empty.
Empty, right? And you drive by them now and they're pretty full, right? And that lack of demand at the dealer level impacts their suppliers and so on. And on the flip side, we're seeing enormous demand for AI-related type products, right? The increased use of services like ChatGPT means we need more computers, means we need more data centers to house those computers, which means the companies that supply those data centers are doing very well right now.
Great. Well, we're going to dive into the consumer a little bit more, but let's get to some poll results. About 30% of you, the highest percent answer was that you feel equally optimistic about current and future conditions. 27% of you feel better about current conditions than you do future conditions. 14% of you feel better about future conditions than you do current. 16% of you are equally pessimistic about both. And then we've got 13% that are just not quite sure. So let's go to our next question here. Again, I'm coming to all three of you. David, we'll start with you. So much of the economy is built around the consumer. We've talked about that even a little bit already. Both their financial situation, but also how they feel that can really influence their behavior. Is the consumer financially strong? And then maybe, how also are they feeling right now?
Yeah, I've talked a lot in the past about real wages, and real wages are wage gains minus inflation. And real wages turned positive about a year ago on a month-over-month basis, and then probably the middle of last year, June or July, on a year-over-year basis. And this was due primarily to the decline in inflation. And real wages are one of the most important indicators we look at Thrivent to see how our clients are feeling. I share a chart of real wages every quarter with our board of directors at our meetings, and we see that Thrivent clients are more willing to make long-term planning decisions when they feel confident, and that confidence is really driven by real wages. So there's some good news and some bad news. Lower and middle income consumers are more reliant on credit and affected by rising rates, as we discussed. But real wages have increased for everyone, and they've increased it faster at the lower and middle income levels, which is great to see.
Great. Steve, how about how people are feeling?
Yeah, I think sentiment overall is pretty good. So there's two widely followed surveys of sentiment. One is from the University of Michigan that focuses on inflation. So that tends to track common items that people purchase regularly. So it's gasoline, food, and then rent if you pay rent. And if you look at those three items at the height of the pandemic, in 2022, the height of inflation, it was 18% higher year over year, which is huge. And sentiment naturally kind of tanked then. It's improved as inflation has slowed down, but it's still not back to normal. The other survey is from an organization called the Conference Board, and that tells a very different story. And that one focuses on jobs. So it never really went down as deeply. Confidence always stayed pretty strong there because the job market has been good throughout. And it's been solid. What's really interesting, and this goes to kind of the poll question, is that people are more confident about the present, but they're apprehensive about the future. And that may be because a recession has been predicted, and you hear a lot about it in the media. But people are also really concerned about the political environment, a little apprehensive about that. So I think overall, while consumers have concerns, the economic data has been pretty good. There's something called the misery index, which does what it says, measures how miserable it is. So it's simply adding together the inflation rate and the unemployment rate. And during the 70s and 80s, it was horrible because both were very high. And right now, it's actually low versus history.
Well, Jim, anything to add?
Yeah, I think, we talked about the consumer's excess savings and the large amount of equity in homes. That's really a large source of potential future consumption for the consumer. So we're watching for signs of the home equity loan data over the next couple of quarters, really as to see where that moves to get a read on how the consumers are feeling.
Great. So we can't not touch on inflation a little bit more here. I have a few questions, Steve, for you. We are hearing, as you already said, right, about inflation slowing down, but we're all still experiencing those prices that are much higher than they were at pre-pandemic levels. Can you talk about the difference between slowing inflation and deflation?
Yeah, certainly. You're right. Inflation is front and center. It matters to the Fed and affects them, and which affects the economy. So when we talk about inflation, it's about how much prices are going up. And inflation rate is measuring how they're moving in percentage terms. So that's year over year or month over month. And when inflation actually turns negative, that's called deflation. It means prices are actually declining. And you can see that now, particularly in goods, where prices ran up in the pandemic, like appliances, prices are actually falling right now. And the good news overall is that the inflation rate has slowed. It hit a peak of about 9%, and now it's about 3%. So it's progress. But the issue is that price levels are really high, and those have not come down materially. So one of those surveys asks, is it a good time to buy different items? One of them is a car, and it's very strongly, no, it's a bad time to buy a car. And you can look at used car prices, and they're down year over year, but they're still 32% higher than they were before the pandemic. And prices overall are about 20% higher than they were before the pandemic.
Well, we're going to come back to that, but while we do, I want to ask the audience another poll question. So we'd like to know, where are you feeling the most price pressure in your living expenses? Got 5 options again. 1, the price of fuel, so gas and utilities. 2, the price of housing. 3, the price of food and groceries. Number 4, the prices of services, so your salon, car repairs, dining out. Number 5, if there's another category maybe where you're feeling some pressure, select that one. While you answer, and we're coming back to Steve with another question. We can't talk about inflation without talking about the Federal Reserve. And it does appear that they may have a little bit of a longer chess game underway here than they had initially hoped with inflation. What's happening, and what could that mean for interest rates?
Yeah, sure. The Fed definitely does have a longer game. It certainly has a longer game than the market expected. So, as I mentioned, inflation is easing, is rising by a smaller amount, but there are elements that people call sticky. So, the very sticky inflation is actually something the Fed measures, and that's in areas like airfares, medical services, and rent. And the issue really is that last mile of progress toward the 2% inflation goal is very hard. And recently, over the past couple of months, inflation has surprised to the upside, meaning it's come in stronger than expected. And this stickier inflation means that the Fed is going to cut rates more slowly and keep them, what the media and the market call higher for longer, essentially.
I think the markets were thinking around 7 cuts at the beginning of the year.
Yeah, exactly.
Starting in March originally.
And those expectations changed very, very quickly recently because the Fed has been very clear that they want to make sure that inflation is defeated and that rates are not going to come down probably as much as the market expected. So heading in, it was 7 times that the market expected the Fed to cut, and that's fallen down to 3 times. And when we talk about a cut, we mean a quarter of a percentage point. And the problem with 7 was that assumed that a recession was going to happen or the economy would slow very significantly. And right now the consensus is for a soft landing or no landing, the economy still holds up very well. So that's why the market shifted. And to us, that sounds about right. We expect very steady, measured cuts from the Fed.
Great. Well, let's get to your answers on that poll question. I'm not going to read them all because there is a one category that is by far and away the most painful right now, and that is the price of food and groceries. 57% of you said that is where you are feeling the most price effect at this time.
Sticker shock.
Yeah.
Checking out, right?
It is, and eating out too. Okay, so coming back to interest rates, I'm going to come to all 3 of you. I'm going to start with you, Steve, but I think it's important to think about why rates matter. So I'm hoping you can talk about why do they matter, and what would a longer period of time with higher rates mean for the consumer? And then I'll come to David and Steve with what it might mean for the business.
Yeah, like you mentioned, I think it's a good time to kind of review why they matter and how they work. Higher rates raise the cost of borrowing for consumers, so it's more expensive to get a house or a car or a big ticket item that you have to borrow for. It also raises the cost of borrowing for companies, so that's maybe a new factory, that's maybe expanding inventory. And these higher rates sort of act as a brake on the economy because it gets more expensive to borrow, and then people borrow less, and if they borrow less, they spend less. So if rates stay higher for longer, it means that the Fed basically has its foot on the brake of the economy for a little bit longer. So mortgage costs would stay higher for longer. Credit card rates would stay at a very high level, although they really never go down. No, they don't. And financing costs for businesses would be higher too.
Let's see, David, do you want to talk about the consumer?
Sure. We already mentioned that higher rates put more pressure, particularly on middle-income consumers. But I try to be positive, so I'm going to be positive here. And that's that consumers are earning much higher yields on their savings now than they were before, which increases spending power over time. So if you're saving to buy a car or take a vacation a year from now, you're actually earning a good yield between now and then. And yields are positive in real terms now. It wasn't that long ago that inflation was actually higher than what you were making on your savings, say in a bank account or a money market fund. And now real yields are positive. That's great for savers, and we know a lot of Thrivent clients are good savers.
Great. How about from a business perspective, Jim, what might higher rates do there?
Well, I think, as was kind of mentioned, right, the higher rates are already putting stress on companies with high debt levels. We've seen that, but high rates aren't bad necessarily for all businesses. Those with a strong competitive advantage tend to be in a good place. They have a better chance of, 1, being able to pass those higher rates along to their customers, and 2, they can take advantage of opportunities to invest for growth, win market share from those companies that are more stressed.
David, anything to add?
Yeah, as Jim said, some sectors are hit harder than others. One that's often talked about in a rising rate environment is housing. It's very interest rate sensitive because people typically take out mortgages to buy homes. But there's a flip side to that in housing, which is there's a lot of pent-up demand due to demographics. We've seen strong what's called household formation. We've also seen an increase in immigration in the last couple of years. And then there's a lack, that's so strong demand, but there's also a lack of supply. In 2008, 2009, of course, we had the housing crisis. Not a lot of homes were built shortly thereafter. And then during the COVID years, there was also not a lot of home construction because of supply chain issues and lack of demand initially. So could be a good period for home builders. Higher rates are also good for financial firms like banks and insurance companies. Now, it's not good if the rates rise too fast. We saw a little bit of that last year. We had some regional banks that had challenges last May as the Fed raised very aggressively. But if rates normalize at higher levels, as we kind of expect they will do, that would be good for financial firms, including for Thrivent.
So the Fed doesn't just look at inflation. They also have a mandate for strong employment. And the job market seems to be holding steady. Steve, I'd love to know how that strong job market might impact the Fed's decision on when to cut rates.
Yeah, certainly. So the Fed does have sort of a balancing act between its two mandates, inflation and jobs. They want a strong job market, but they don't want it too strong. Right now, the labor market is slowing a little bit, but it's still very solid and still creating key jobs. I think the key risk going forward is that the labor market becomes tight again and it overheats and pushes up inflation, and particularly through higher wages. And what the Fed is really concerned about is not wage increases, but them getting out of control and going too high, because that can create what's known as a wage price spiral, which we've talked about before. Yeah, it was present in the 70s where wages go up, companies raise their prices, and then consumers want higher wages again.
To be able to afford
and then it just
that,
cycles.
Yeah.
So I think unless employment rises very significantly, which is certainly not our case, the Fed will take its time, very measured in taking cuts to make sure that the inflation is defeated and that the job market doesn't overheat in particular. Outside of the Fed, I think there are really positive forces in the labor market right now. One of them is the labor force is still expanding, and that's good because it alleviates worker shortages, which has been a big issue for the U.S. labor market. And the other is that productivity is expanding, so you can make more for less, and that's really good for inflation.
Well, speaking of productivity, David, I know this is something you've really kept an eye on. What are you seeing now?
Yeah, I've talked a lot about productivity in the past, and I was concerned. I thought it was a risk to the economy, and 2022 productivity, and really into the first part of 2023, was terrible. Productivity in calendar year 2022 declined almost 2%. We rarely see actual declines in productivity. The good news is that improved significantly in the second half of 2023. The number for the fourth quarter just came out 10 days ago or so, and we're up 3.2% for the quarter, and that's on an annualized basis. So
that's very high.
That's very strong productivity. Kind of anything above 2% is pretty solid. So what happened? And I mentioned before a speech from one of the Fed governors, Lisa Cook, that I thought was good, and she talked about how it's harder to make productivity gains in services versus goods. And coming out of COVID, there was tremendous demand for services. People were going to get their hair done. They were going out to dinner. And so we saw a decline in productivity just because it's harder to make gains in services. And the question was whether, as that normalized, the demand between goods and services normalized, would we see productivity pick up again? I kind of hoped Lisa Cook was right, and it looks for now like she probably was. So you see that recovery in productivity. One aspect that probably isn't in the numbers yet is artificial intelligence, AI, or generative AI in particular. It probably hasn't boosted the numbers a lot yet, but I think it holds the promise for tremendous productivity gains, especially in the service area. And that's important because the Fed's biggest concern around inflation is service level inflation. As Steve mentioned earlier, goods inflation has kind of been around zero, even in some cases where we have goods deflation. It's really services inflation that's the problem, and AI could potentially be a solution to that. And then the last thing is if AI helps control inflation by making employees more productive, that could allow for higher real wages, again, without driving inflation. And it all comes back to real wages.
Well, we've seen in some sectors, even especially in services, where employees are 30% or more productive just using AI assistance. And so that's, as you think about where that can go, a lot of productivity can come from that.
Yeah, it's interesting. When the personal computer came out, people expected productivity to show up. It didn't for a decade or more than a decade. But you're seeing bits of it right away with AI.
Very quick.
A lot of promise going forward.
Well, we've talked about the U.S. economic environment quite a bit, but I'd like to talk too about the global economy, Steve. What's happening in the global economy, but also what's happening from a geopolitical
Sure,
perspective?
certainly. The global economy has been more challenged than the U.S. economy has been. It's been soft. I mean, there's some signs it's bottoming and starting to turn up a little bit, but Europe in particular has been struggling with weak growth, and they are either in or heading into a recession, most likely. And China, another very large economy, has been underperforming with slowing growth and really a very, very weak real estate market and high debt levels. And the U.S. economy has been outperforming pretty significantly globally recently. But a slower China and European region matter because they're the second and third largest economy, which depends on how you measure it. But it's really important for trade, and it's really important for U.S. multinationals. So if you look at Apple, for example, they've had problems in China, which is a huge market for them, and it's slowing down for them. Geopolitically, there's a lot going on right now, and the world is really pretty unsettled right now. So you have a war in the Middle East, you have a war in Europe with Ukraine, you have conflict in the Red Sea with groups targeting shipping on a really critical route from Europe to Asia. And you have Iran and North Korea, both are potential flashpoints that could draw the U.S. into a conflict. And then China appears determined to reunite with Taiwan peaceably or otherwise. So what does this all mean? Probably not a lot, actually, because you look historically, and we've talked about this before, is that geopolitical conflicts don't tend to impact markets over time. You can get a spike in oil temporarily. You saw that with Ukraine. You saw that with Gaza. But it's rare for them to impact them over time. Where it can is if supply chains are disrupted, particularly for a certain good. And that happened for the U.S. in the 70s when there was an oil embargo and inflation shot up. But that hasn't happened. It's rare for that to happen.
And I know it's proven true every time you told us in the last couple of years when things have happened. Well, we've talked about the economy and employment, wages, inflation, jobs. These all sound like topics that might be particularly important during an election year.
Do we have an election coming up?
I've heard whispers. It's just in the background there. David, I'd like to know how you're thinking about markets in light of the elections coming up.
Sure. And much like Steve was talking about with geopolitical events, elections actually don't tend to move markets as much as most people would think. They're really important, just like geopolitics, very important in other ways, but they don't tend to move markets as much as you would think. And this particular election, we don't have some of the usual policy differences between the two major candidates. Both are essentially protectionist, particularly with respect to China. There really isn't a free trader running. Both are likely to continue spending and add to the deficit and the debt. So there's really no deficit hawk running. What I worry about most, probably from a market perspective, is consumer and business sentiment. What you could see is half the country upset with the outcome of an election, or maybe even questioning the legitimacy of the outcome of the election. And that could be a drag on confidence, which can be a self-fulfilling prophecy. I think the biggest policy difference between the two candidates is probably on regulation. In terms of sectors, healthcare and financials would probably benefit from a lighter regulatory touch from the Republicans. Democrats are probably better for green energy. Traditional energy is kind of interesting if you think about like oil and gas exploration. Republicans tend to allow more drilling, but if Democrats restrict drilling, that can actually be good for prices. So it's not always clear-cut which party is better for traditional energy.
A little counterintuitive there. All right, well, we're going to talk about the markets a little bit more, but we want to hear from you with our final poll question. We want to know, do you feel you're prepared to navigate the markets in 2024? You have 4 options here. Yes, you feel prepared. Yes, you feel prepared with the help of your financial advisor. No, you don't feel prepared, or other. So while our audience is answering that, David, let's talk about some insights. The markets have reached new record highs already in 2024 pretty quickly. Obviously, it's early and a lot can change, as we've seen in other years. But do you expect kind of that same upward trajectory, or are you expecting some bumps?
Well, I did have the Christmas ornament.
That's
last
true, the
time.
airplane.
I had
yes.
the airplane with my little biplane going upward from the royal family Christmas tree. I've been optimistic, and I still am, but I'm tempering that optimism just a little bit. I think I'm naturally just a little contrarian. But I think the market's pretty fully valued at an index level. A lot of those gains have been driven by the so-called Magnificent Seven, these big technology names. So I do think there are some opportunities for some broadening in the stock market. Jim's going to talk about small caps here in a second. It's never a good idea to sell stocks based on valuation alone. Just because stocks are fully valued doesn't mean they can't continue to be for some period of time. But it is probably a good time to think about rebalancing and rebalancing to your long-term allocation. The stock market's had a good run, and particularly even into this year. So if you're overweight equities, this would be a good time maybe to take a little bit of that off the table and rebalance back to your long-term target. We did a little bit of that recently in our funds. We're still a little overweight equity. We still like stocks. But I do think we're going to see some bumps. Volatility has been historically low recently. I've made the comment it feels a little 2017-ish in that was a year with low volatility and the market kind of grinded upward. Fun little story, I actually called my mother last night. And I, we were talking about this event, and I'm sure, hi Mom, I'm sure she's watching. But she said, I noticed people aren't talking about the market as much these days as they were maybe a year ago. And I thought that was a really good assumption. That's what happens in a lower volatility market where it continues to grind higher. And I tend to be a little skeptical when the market and people overall tend to be a little optimistic. So we still love stocks for the long term, but even when you're long-term bullish, it's good to have a little dry powder. And so, I think we would be looking in a market downturn probably to add to equities, but I kind of like being kind of near our long-term target right now.
Yeah, and while a down market is very hard, it's also a great opportunity. Yep. Often we look at it as sort of a sale on stocks that we like.
All right, well, let's get the results from the final poll here. Great news, actually. 61% of you said that, yes, you feel prepared.
I was hoping we'd get a lot of number two. That's what I was. I didn't want to say it.
Financial advisor, yeah. So great job, financial advisors. And we obviously appreciate the opportunity to help you there. Feel prepared for whatever might come. Okay, so let's talk a little bit more. As the economy continues with underlying strength, where do you see maybe some market opportunities or constraints?
Sure. Healthcare and technology are two of our long-term themes. Tech because a lot of the innovation we've talked about, and healthcare due to demographics. We have an aging population that's going to need more healthcare. Healthcare underperformed last year, and so I think that could be attractive for over a long-term horizon. Also, a lot of the technology gains were in the big companies. We've talked about the Magnificent Seven. So I think there could be opportunities in small and mid-cap tech. That's certainly something Jim can talk about. We are, as Steve said, cautious on international stocks. China has challenges with, a bloated real estate sector, challenging demographics long-term, political crackdowns. But also on the fixed income side, and I'll see what Steve says here in a second, I like longer term high quality bonds here. There's a lot of cash still sitting in money market funds. Those yields will go down as the Fed starts cutting, and eventually they will cut. If rates have probably peaked, and we think they likely have for long-term rates, this could be a good time to lock in some of those long-term rates. And I would do it with higher quality bonds. I don't think you're getting paid a lot for taking too much credit risk. And another area that I would look at, speaking of high-quality bonds, in taxable portfolios would be municipal bonds. They offer some pretty attractive long-term yields in this environment.
Steve, anything to add?
Yeah, certainly. There's always opportunities in markets, whether they are going up or down. We've talked about it. Markets have been driven by a few tech names, very large tech names, so-called Magnificent Seven. Valuations are high there, meaning that the stock prices are more expensive relative to what these companies earn. I think there are opportunities to the other 493 members of the S&P 500. And this includes value stocks, which tend to be a little bit less growth-oriented and less expensive relative to other stocks. I think to really get that part of the market going, we need rate cuts by the Federal Reserve, and then a strong economy that is sustainably broadening and strengthening, but not too hot so that inflation comes back. And then David talked about this, fixed income yields look very attractive, especially relative to the past 15 years. So there's an opportunity to move out of short-term instruments like cash, where rates would fall immediately when the Fed starts cutting, and you can lock in higher long-term yields. So we would favor higher quality parts of the market, like investment grade corporates, or as you mentioned, municipals.
And there have been tremendous flows into money market assets. About $3 trillion of excess money market assets are kind of sitting on the sidelines right now. And last year, our own money market fund had over $1 billion of net inflow. So a lot of folks are in that money market space. Again, as the Fed starts cutting, you have that reinvestment risk where those rates will come down. It could be a good time to look at locking in some of those longer term rates.
Yeah, and I'd echo what Steve said, right? That regardless of the macro environment, we're always seeing opportunities here. Some investors may paint small caps with a broad brush, but they tend to miss out on companies positioned for outperformance there. As sentiment changes, it really provides us opportunities to find quality businesses that are attractively priced with long runways for earnings growth.
Well, we're going to stay with you, Jim. On that note, I have a few questions. We do our deep dive with our special guests, so we're going to talk small caps. Can you define small caps for us and kind of give us an explanation of that universe?
Yeah, definitely. I think last quarter's economic update, you hosted Lori Brunner, our large cap growth manager. She did an awesome job, by the way. Many of the companies she talked about are big and widely known names. In small cap, there's not as many that are really recognizable brands that are front and center in our daily lives and everything we're doing. They can be distributors, suppliers, manufacturers for some of the large companies, which gives you opportunities to still get some exposure there. But another interesting part too about the universe is that there are you can gain exposure to larger private companies that you can't get exposure to, and typically through their suppliers. So take Chick-fil-A, for example. Popular restaurant concept. They're private. You can't buy their shares on the New York Stock Exchange, but you can buy a company that's small cap that makes the Chick-fil-A sauce that they sell at the restaurants.
Sure, a great way to get exposure there.
Yeah, and then for some context just on the size of the small cap universe, maybe I can make the analogy to a large metropolitan downtown, Minneapolis, where we are today, right? The tall recognizable buildings in the skyline, those are the large caps, and all the other small buildings around, you could think of those as small caps. There's 5 times as many small cap companies as large. And if you think about the average market value and the profits that the large caps have from a magnitude perspective, they're like the big buildings. They're 10 to 100 times more profitable or larger market values than within small cap.
Great explanation. A lot more companies there. And with that kind of helpful color that you just gave us, I'd love to know about your process. Like, how do you find these companies with so many of them out there?
Yeah, of course. First, maybe just start with, we hold roughly 100 stocks out of the more than 3,000 in our universe. So, that allows us to dive down deep, really get to know these businesses. We meet with their management teams, with their competitors, with industry experts. And once an investment decision has been made, we're often owning a meaningful position in that company.
And I think that's important to recognize. We take pretty meaningful positions because these are small companies. We might own a significant percentage of the company. And these are companies that are not widely covered in many cases by Wall Street analysts. This isn't Apple or Microsoft. And so Jim gets to know these companies very, very well, gets to know the management. Fun story for our viewers, we had our first meeting to talk about this event, and Jim showed up in jeans and boots and a pullover because he had just been walking a factory floor from a local supplier.
Yeah.
I think a supplier for Target, if I remember.
Yeah. So,
Very cool.
Yeah, it is. I love getting out and seeing these businesses. And back to the process though, right? The fundamental process for investing for us is 3 parts. Right? So valuation, we're looking for 30 to 50% upside over the next 2 to 3 years. Operating, we're looking for operating performance to be stable or improve beyond consensus expectations. And then from a sentiment perspective, we're really asking ourselves, what do we believe that others don't fully appreciate?
Yeah, so if you're finding things you don't think other people know or appreciate, do you have to be patient then? Until the market kind of comes around and realizes what you see?
Yeah, sometimes it depends, right? Sometimes we may learn something that we expect to be a catalyst in the near term. So we've discovered that an announcement that may come this year will have materially larger market impact or market size than most people expect. Or it may be sentiment is poor in a bad environment for a quality cyclical business, and we need to look out further than other investors and really make that investment based on the next 3 to 5 years and not next year.
Would love to know, how you're seeing some of these small cap companies really use innovation as an opportunity to compete in the marketplace.
Yeah, innovation's an interesting topic. Over the last 20 years, it's broken down many of the barriers that these larger companies once had. Large companies traditionally had economies of scale. It cost a lot to hire IT engineers, to build distribution networks, large data centers, things of that nature. But now as a small business, you can effectively rent all of that from the likes of Amazon or Microsoft. On a company-specific basis, what we really want to do is understand if a business has a competitive advantage. And innovation can be a large part of that advantage. We've seen, take for example, vacuum cleaners, floor mops. They've been around for a long time.
Quite a while, yeah.
And it's changed over since we were kids, right? There's a small cap company that makes these, and not only do they invest in product design, making them easier to use, but they're also designed and manufactured in a way that makes it cost less. So providing a product to a consumer at the same or better functionality for a lower cost, that's a competitive advantage that we really like.
I love it. Okay, how about last question before we get to our live Q&A? What kinds of trends and opportunities are you seeing with these companies?
Yeah, in this environment, a lot of companies are tightening their belts. They're talking about cost saves, efficiency improvements, and maybe prudent capital spending, similar to the consumers that you were kind of talking about. We're finding opportunities in both faster growing and more stable businesses that are attractively priced with long runways for earnings growth. So technology sector is one Dave mentioned, both the software and in hardware industries. We've seen some opportunities. And then within the food sector, we saw a big bump from COVID as people were forced to eat at home. And that's a few years behind us now. That's started to normalize. The consumer is healthy, as we talked about, eating out. And so that spending, those volumes have really normalized back to pre-COVID levels in many of the kind of eat at home type of parts of the sector. With that being said, the food sector tends to not innovate much, right? You walk down the cereal aisle.
Rice Krispies then or Rice Krispies now?
Yeah, exactly. So we've found some businesses in that sector that really have new product innovation, and that's providing opportunities for them to outgrow the market.
Wonderful. Thank you so much for that insight. All right, it's now one of our favorite parts, which is where we get to answer some live Q&A. That's right. Buckle up. Here come the hard questions. I'm going to start actually with one.
We don't know what Kelly's going to ask.
It's
fun.
all. I feel powerful in this seat. Steve, the first question is going to come to you. We have a listener who wants to know, is 2% a realistic target for kind of that neutral rate for inflation for the Fed?
Yeah, that's a really good question, and actually one that the market thinks about. I think in the near term, the Fed has to keep the 2% target because it set it, and if it were to back off from it, it would destroy their credibility because it looks like they're moving the goalposts. Longer term, I think there's a case to be made that maybe it's a little bit higher, but in the near term, it's still going to be 2%.
And it hasn't been around forever. That was a Ben Bernanke.
No, and they just kind of
pulled it out.
Pulled it out
Yep.
because if it's 2%, they set rates high enough so they can cut them.
Yep.
Partly, yeah.
Absolutely. How about a question actually on the outlook for the real estate market, both maybe at the commercial real estate level, and then we'll turn to some of more of the individual.
Sure. There's a lot of press around commercial real estate, but it's not all one thing. And Thrivent has a significant commercial real estate portfolio in our insurance company general account. It's about $9 billion. These are loans on commercial buildings, and we have very little exposure to kind of downtown office buildings, which has been kind of the epicenter of a lot of the problems. And our commercial real estate exposure, our biggest positions are in. The category would be industrial, but think like warehouses for Amazon, and then multifamily, which would be apartments and housing. And we talked about all the demographic challenges. There's an undersupply of housing, so those are two pretty good areas to be in. It's something we keep an eye on. There are some second and third order effects to the commercial real estate market. That's one of the concerns around regional banks that we saw last year.
Yeah, and the market is telling you they don't believe it's a systemic problem like mortgages were during the great financial crisis. It's an issue for some smaller banks because they're heavy real estate lenders. But one of the things you're seeing right now is, particularly for office buildings, is they're kind of pushing out the debt. They're kind of extending the maturity and seeing if things get better over time. But yeah, it's an issue, but it's not economy-wide systemic problem.
Kind of seeing if there is a kind of return to a workforce in the office.
Yeah, exactly. And there's a lot of private money coming in and kind of slowly, buying up properties.
Yeah. Well, okay, you mentioned private companies coming in. We've had a couple questions about private investments, David. So maybe I'll come to you with this one. Private equity, private credit. How does Thrivent have exposure there?
So we have we've had Jen Wilson on, who
Yes.
runs our private equity portfolio for the insurance portfolio, the general account. We got about $9 billion in private equity, and really like that asset class over the long term. We do have some exposure to private credit in the general account. These are just the private loans to companies. But one interesting fun fact about our private equity team is we have recently added private equity. It's a small allocation, and it's particularly small initially. It'll grow over time to our flagship asset allocation funds. So this is an asset class that typically you've had to be a large institution like Thrivent or a very high net worth investor to invest in. And by adding a small piece to our asset allocation funds, you can get access to private equity for as little as $50 a month.
That's pretty great access. That's an exciting trend. Jim, I have a question for you here. Someone wants to know, are small cap stocks going to be a more profitable sector than large caps in 2024 and 25?
I hope so. We'll see. I can tell you what we have seen over the last year is estimate revisions for earnings have been coming down on the majority of small cap stocks. Some have been going up, but the majority have been coming down. And, what does that mean for the future? Well, we're starting to see that, some areas of small caps are starting to feel kind of, hey, it seems like they're bottoming out. And so hopeful for growth going forward, but it really depends on a lot of the macro stuff that these guys talked about as well, and where the consumer ends up and how that ultimately flows down to a lot of these businesses.
This is where the contrarian view comes in. As estimates come down, it becomes easier to exceed estimates. So
Sure.
That's kind of when you want to be paying extra attention to the small cap space.
We have another question asking about what indexes are good to follow. We talk about a lot of different ones.
Dude, that's a really good question. So I'll start with what I wouldn't pay attention to, which is the Dow Jones Industrial Average. And the reason I wouldn't pay attention to that is it's calculated using the share price, not the size of the company, which is kind of an arbitrary thing. So the weightings themselves are arbitrary based on the prices of the constituent companies. The most widely followed, of course, is the S&P 500 index, but that's an index of large capitalization companies. The NASDAQ index, of course, is focused more on technology companies. But there are broader indices. The Wilshire 5000 is a famous one that covers essentially the entire market. The Russell 3000 would be another one that would cover broad market exposure. And then, of course, there are other more tailored indexes. Jim would follow the S&P 600 small cap, or the Russell 2000 is another small cap index. But I would look more broadly at the S&P 500 and the Wilshire 5000 if I want to know how the market overall is doing.
Excellent. And probably not try to time the
And
market.
don't try to time it. Your advisor can help with that.
Excellent. Here's a question that we actually had a lot in the pre-submitted questions, and I see it's popping up here too. David, would you share your perspective on how to think about cryptocurrency and Bitcoin?
Absolutely. And so Bitcoin had a pretty strong run. It's declined a bit recently. One thing we know about Bitcoin is it is volatile. Yeah. And that can be potentially a useful thing for a diversified portfolio. If you can have a small allocation to a volatile asset class, it could potentially provide diversification benefits, again, in a diversified portfolio. The challenge with Bitcoin is I don't think anyone knows really what it is correlated with. In 2022, when rates shot up sharply, it performed a lot more like an unprofitable technology company. Companies that had earnings far out into the future and higher rates really affected their valuations, and Bitcoin went down dramatically. More recently, rates have ticked up, and yet Bitcoin has performed reasonably well. It's been a little more like gold, which was kind of the promise of Bitcoin as virtual gold. It did not behave like that in 2022. So if I wanted to put it into a diversified portfolio and get that diversification due to its volatility, the first thing I'd want to know is, what are the correlations? And I don't think we really understand that yet.
Yeah, it behaves very much like a risk asset. So when it's risk on, it does well, and you don't really get that flight to quality that you do for gold, like in times of trouble. People will rush to gold.
Yeah.
Okay, well, you both mentioned gold, and that's another question. What role do precious metals like gold play in a portfolio? How would you think about that?
Gold tends to move somewhat with interest rates because you don't get any income off of gold. So when rates are higher, gold, you lose that potential of income, and gold tends to do a little bit worse. It does well in times of trouble. A small role. I mean, it can be a diversifying role, but you want it to be kind of single digit type of role.
And you don't have to own physical gold. You can own mining companies, other ways to get exposure to gold too.
Great. So I don't know who wants this question. I'll just toss it up and you all can jump for it. But we want to know a little bit about the national deficit. What do you see happening with the national deficit? When is this really going to become a concern for us?
I'd start off with that one of the underappreciated things I think about the deficit right now is that we're stimulating the economy. So we're spending more than we take in taxes and fees as a country, which is stimulative to the economy. At the time, the Fed is holding rates higher for longer and trying to keep the economy from overheating. So they're somewhat, in a way, in conflict with each other.
Yeah, and the thing about the federal debt, everyone agrees it's a problem. Both parties have said that. Chair Powell has said that it's not sustainable over the long term. But that doesn't mean that it's going to be an acute problem in the short term. The dollar is still the world's reserve currency. China, Europe have their problems. Hard to see another currency becoming the world's currency. So it's probably not an immediate problem. That's part of the reason why it's easy for politicians to kick the can down the road. But I wouldn't, sit on cash expecting, or gold or Bitcoin expecting it to be an immediate problem. I think you might see it in slightly higher interest rate on Treasury securities. It might cost the government a little more to borrow, but I think it's a problem that would see its realization over time and not in sort of a dramatic immediate.
Yeah, we've seen that be in the news headlines over time, and we haven't seen anything immediate necessarily come of it. It takes time to flow through, I think.
Great point. Let's come back to residential real estate. I kind of promised we were going to talk about it, and then I skipped over it, but we have lots of questions on that, both from buying a home as well as renting. What are you seeing happening in that space?
There's tremendous demand for housing and undersupply.
Yeah. If you look at the housing stock, it's very old. It's the oldest it's been since World War II, which was following the Depression when things were depressed and they didn't build a lot.
Yeah, and so what's happened is between the higher rates and lack of housing supply, we're seeing housing affordability really as low as it's been in recent years, and that's a challenge. So you have a lot of things, unfortunately, in this economy. You have kind of some have and have-nots. If you own a home, the price has gone up a lot. You got all this home equity that most people haven't tapped. If you don't own a home yet, they just seem to keep getting more and more expensive. I'm confident that the supply will catch up over time. Supply chains have normalized. Home construction, hopefully will increase. But you do have a group of kind of semi-permanent renters right now that just can't quite afford between the down payment and the interest payments on a mortgage at this higher rate environment. Hopefully as rates normalize and we get some additional supply, everyone is able to buy a home. But people in that middle income bracket, particularly younger folks, are really challenged right now.
Yeah, and the key is lower rates because it makes it, housing more affordable and accessible to other people. It also allows people who own existing homes to move. Because right now, a lot of people still locked in because they have a 3% mortgage and they can't replicate that low payment. So there's not a lot of turnover.
And that's what's kept the prices high. Just homes aren't coming to the market.
Great. Well, I think that about wraps up the amount of time we have for live Q&A. So we are going to move to our last couple of questions, which I'm excited about.
This is going to be fun.
It is going to be fun. At our last update, we had you bring in Christmas ornaments that related to your outlook for the year. This time I've asked you to come with a quote that inspires you. And so, David, I might start with you.
So I picked a quote from my favorite philosopher, the Danish Lutheran philosopher and theologian Søren Kierkegaard. Maybe familiar with some of our viewers. And his quote is, "It really true is what philosophy tells us, that life must be understood backwards. But with this, one forgets the second proposition, that it must be lived forwards. And in investing, often when there's a crisis of some sort, it sort of seems obvious in retrospect. Well, of course we were going to have a housing crisis in 2008, 2009, or even I mentioned the regional banking issues we had this time last year. Of course, the Fed was raising rates aggressively. Some of these smaller regional banks, especially ones that have exposure to real estate and so forth, were going to struggle in a rising rate environment. But it also teaches us a little bit of humility. Our job is to act with imperfect information. So we do, even though we're only going to understand things looking backward, we have to have the confidence to make decisions with the best information we have and always be looking forward.
Great insight. And I'm just impressed that you have a favorite philosopher. Steve, how about you? What quote do you have?
So I went to Aristotle, a Greek philosopher, and the quote is, "Excellence is never an accident." And we strive for excellence in investment performance. And if you look at every portfolio manager's incentive goal, it literally says superior investment performance, especially over the long term. And the only way you can do that is if it's not an accident and you have a repeatable process and you work very hard. And we do, I think, work very hard for our clients. And, it's an honor to manage the money. And the way I like to look at it is not really just money. It's, somebody's retirement, college for their kid, or the dream vacation.
Yeah, it's a great way to think about it. All right, Jim.
Well,
what do you have for
I
us?
saw their quotes first. So I thought we were having a competition for the oldest quotes. So mine's from Confucius. But,
Okay.
Our greatest glory is not in never falling, but in rising every time we fall. And as Steve mentioned, we strive for excellence, right? But that doesn't mean we're perfect. And money management is a hard business, and the market reminds us of that every day. And if we don't persevere, learn something new every time we fail, and get back up and improve, then we won't be the best we can be as a person or for our clients.
Great. I love that. Thank you, guys. Always very insightful. I wouldn't have expected anything less. David, before we go, I want to give you a chance to talk and tell our clients how Thrivent is doing in this market environment.
I'd love to. We ended the year with a record high of over $17 billion in surplus, so we're more than well positioned to keep our promises to our clients. We continue to have the same credit rating, a AA+ rating from S&P as the U.S. government or Apple. You can decide which of those two is more impressive. We talked earlier about real wages, and it's just an important topic. Our clients feel better when their wages are improving, and we see that in their confidence, and we see it in our results. And 2023 was a good year for Thrivent. For 2024, I mentioned this at our last update, but I'm thrilled to remind everyone we are paying a record by a lot, of $542 million in dividends and policy enhancements to our clients. That's up from $286 million, which I thought was a very big number back in 2021. So over an 80% increase in just 3 years. And finally, I just wanted to wish everyone a happy Easter to all of you, to all of our viewers and their families. I wore my Easter tie for you.
Love
I don't
it.
know if you could see it, but it's got little bunnies and tulips. So I wore my Easter tie thinking of all of you during this wonderful Easter season. As I hope you can tell, I think you can. Our team really enjoys these updates with all of you. Thank you for tuning in. And as Jim and Steve both said, we really appreciate all the trust you placed in us.
Absolutely. Well, we are at the end of our time. Thank you, David and Steve and Jim, for taking the time to share your insights with us. A reminder to you as we sign off today, take the time to meet with your financial advisors so that your financial strategy is up to date and you're able to take advantage of those potential opportunities, of course, based on your long-term goals and your risk tolerance. Thank you again for joining us for this market and economic update. It is really our privilege to be part of your financial journey. And as David said, we wish you and your loved ones a very happy Easter.